Welcome students. Today we are going to study about technical analysis. Last video we learned about fundamental analysis, and fundamental analysis is all about the EIC framework, economical analysis and industry analysis and company analysis. Now let's study the technical analysis. So what is technical analysis? A process of identifying trend reversal and at an early stage to formulate the buying and selling strategy. So we see the stock market and we see the graph charts and different methods like moving average, our relative strength index. Okay, so we use patterns also. We use different types of charts also. So using the past data and with the and putting it into charts and identifying the movement of the market and taking decision. That's how technical analysis helps for the investors. So technical analysts study the relationship between price volume and the supply demand for the overall market and the individual stock. So here we evaluate two things, that is first price volume. Okay, what are the prices going on and how the volume is traded, how much volume is traded, and the supply of the stock and demand for the stock. Now, assumption of this type of in technical analysis is the market value of sharp of the script is determined by the interaction of supply and demand. We know more the supply, okay, the price of the share decline. If demand increases, the price of the share increases. Even the market also goes up. The market discounts everything. That's what the technical analysis says. The market always moves in the trend. Either we will study about different trends are there, and technical analysis says that always moves in the trend. They have a pattern of trend and they follow it. History repeats itself. It is true the stock market also. So it's all about the movement of the stock market, going upper market and going down market and stagnant market conditions. That were the assumptions of technical analysis. Now in technical analysis, let's study about the Dow Jones theory. So Dow developed his theory to explain the movement of the indices of Dow Jones average. Okay, so the theory is based on certain hypotheses. He formed the three type of hypotheses, and first he says the first hypothesis is that no single individual or buyer can influence the major trend of the market. So individual might buy more, individual might sell less, okay, but individual will not affect the market condition. It is the bulk which changes the market. So that was his first hypothesis. And second hypothesis says this hypothesis is that market discounts everything. So if we see market discount everything, and if we look into the example, for example, if there is any natural calamity such as earthquake, plague or fire also get quickly discounted in the market. Same thing happened with the pandemic situation with the COVID. We have seen the market has collapsed continuously. Even the bomb blast which happens in the country, so because of that also even stock market collapse. So that's what market discount everything. And in third hypothesis, he says that the theory is not infallible. So it's not a tool to beat the market, but provides a way to understand it better way. So that's what the third hypothesis. According to Dow theory, the trend is divided into primary trend, intermediate or secondary trend, and short-term or minor trend. Now coming to the primary trend, so the security prices trend may be either increasing or decreasing. So we know that there are two trends in the market famous. One is the bullish trend, another one is the bearish trend. Okay, so bullish trend always show the going the market upper side. So the bull market shows three clear-cut peaks. Each peak is higher than the previous peak. So the bottoms are also higher than the previous bottoms. That market is going to gear up. If you look at bear market, the market exhibits falling trend, we know, and the peak are lower than the previous peaks. The bottom are also lower than the previous bottoms. Now looking into the secondary trend, the secondary trend or the intermediate trend moves against the main trend and leads to correction. Okay, the secondary trend, we say correction would be 33% to 66% of the earlier fall or increase. If there is a fall, then it will correct it to the 33 to 66%. So compared to the time taken for primary trend, and secondary trend is swift and quicker. So because it's in secondary trend, that's why it is very swift, and also it is very quicker. Now moving to the next is the minor trends. So minor trends or tertiary move are called random wriggles. Okay, so they are simply the daily price fluctuations. So minor trend tries to correct the secondary trend movement. So these type of trend always comes in the market scenario. So we saw the rising and we saw a flat also, and there is an falling trend also that we call. Now, coming to the next is the most important is the support and resistance level. So there are two things which comes in the market pattern. One is the support level and another one is the resistance level. So support level exists at a price where considerable demand for the stock is expected to prevent a further fall in the price level. So this step is called support level. In the support level, the fall in the price may be halted for the time being, or it may result even in price reversals also. So after that, the falling price may start in going up and up. So if the stocks goes down to certain level and then rises, there exists a support level. So if the price goes below the support level, it means that selling pressure has overcome the buying pressure, and the price may fall further also. And with the support level, there will be a resistance level. So resistance level, what it does is, it stop, and it, you can say, it stop the rising of the price more further. Okay, so selling pressure is greater and the increase in the price is halted for the time being. So when the stock touches a certain level and then drops, it is called as resistance level. If the price moves above the resistance level, it means that buying pressure has overcome the selling pressure and the price may rise. If you see the chart, here we can identify. So if the market is moving and up and up and up and up, so this comes the resistance level, which will not make to further increase in the price of the share. So buying pressure should be reduced. And if it starts goes down, the pricing down and pricing down, so here we see support level. So it support level helps no further fall in the price, and it the trend goes to return. It helped the trend to go up and up. So these are the resistance and support level. So let's understand the charts and its types. So charts are the valuable and easiest tools in the technical analysis. Okay, it's all about the graphic presentation helps the investors to find out the trend of the price without any difficulty. So let's see the types of chart. And first comes the line chart. We all know line chart. So we use to calculate this even on graphs also. And even we take this in our Excel sheet also, we can calculate. So this is the basic chart. In other it's called line chart. It represents only the closing price over a set of time period. So the line is formed by connecting the closing price over the time. So they continuously they will check and they will be connected, and these dotted prices will be connected and will be created the line chart. Now coming to the next is the bar chart. So it represents the bar diagram. We also know we can calculate in Excel sheet also. So these are made up of series of vertical lines that represent each data point. So the vertical line represent the high and low for the trading period along with the closing price. So in each line, vertical line, we can identify what is the closing price and what is the opening price. The close and open are represent on the vertical line by a horizontal dash. Okay, so we can see it here. So this is horizontal dash. We can come, and this also we can notice. Okay, so these are all the dashes which says about close and open are represented. The opening price on a bar chart is illustrated by the dash that is located on the left side of the vertical bar. Okay, and the close is represented by the dash on the right side. So if you see, so the opening and the closing that can be easily identified in the charts. So one is the left, another one is the right. Next comes the point and figure chart. So this type of chart, it predicts the extent and direction of the price movements of a stock or a market index. So these charts are on dimensional without any indication of time or volume. So they show price changes in relation to the previous prices. It consists of the series like x-axis and o-axis. So the x-axis represent upward price trends and the O's represent the downward price trend. If we see the time, so we can here we can easily see. So this is all downward trend we can see, okay, and there is an upward trend which has been shown with the X and S. So the price are given on the left of the figures we can see on the axis, and the prices can change in intervals of 1, 2, 3, 5, and 10 points. Higher points are chosen for higher price stocks. Okay, at the starting point, the X is placed and another X is placed if the price increased by 1 point. Okay, if the price decreased by 1 point, so 0 is placed in the next column below the X, and further 0 is placed if the price decreases. So we can see here, first one is the falling, we can easily notice, then there is a rise, then again fall, then again continuously rise, then again there is a fall, so again rise, fall. So that X and 0 will be represented with the point and figure chart. Now, if you look at the chart pattern, so chart pattern is a distinct formation on a stock chart that creates a trading signal or a sign of future price movement. So chartists use these patterns to identify current trends and trend reversal and to trigger buy and sell signals. So with this, we can understand whether to buy it and whether to sell the stock. So in one, first is the V formation. So you can see in the chart, one is the downward and upward V formation. So V formation, there is a long sharp decline and a fast reversal. Okay, in the V pattern, the market interest changes quickly from hope to fear and vice versa. So in inverted V, first the price rise occurs and then it starts declining. So we can see here price rises, then it starts declining. And if you look at here, first here from top to price declines, then it starts moving upper side. So this is V formation. And next come the top and bottoms. So top and bottoms are formed at the beginning or end of a new trend. The investors should buy at the bottom and exit before the top has been reached. And we have double tops and bottoms also. So double top pattern and double bottom. We can see it here. So double top, top 1 and top 2, and this is double top. Okay, and when we see this is we have two top, okay, 1 and 2. Okay, when it comes to the double bottom, we have two bottom lines here. Okay, so these are called double top and double bottom. Next comes the head and shoulder. So this we can easily identify with the help of a chart. So we can see this as a shoulder 1, and this is shoulder 2, and this part as in head. So this is called head and shoulders. So this is one of the most popular and reliable chart pattern in technical analysis. Most of the people use this. Okay, in the head and shoulder pattern, there are three rallies resembling the left shoulder. Okay, we can see that here. Okay, so a head and a right shoulder, a neckline is drawn connecting the lows of the tops. So we can see, we can easily can see that this shoulder and this is the shoulder and this is the head, and this can be seen. Okay, so when the stock price cuts the neckline from the above, it signals a bearish market. So after that, the price starts falling. And head and shoulder top is a chart pattern that is found at the high of an upward movement and signals that the upward trend is about to end. Next is the inverted head and shoulder. So it is the reversal pattern of the head and shoulder. So we can see shoulder here, okay, and head, and again shoulder. Okay, so inverted head and shoulder is used to signal reversal in a downtrend. When market is at a downtrend, we use this. So it's vice versa type of thing of the head and shoulder. The top of the inverted head gives the neckline, When the price pierces the neckline from below, it indicates the end of bear market and the beginning of the bull market. So here we can see this is going on following the bearish trend. So once it reaches, then comes the bullish trend. So prices are going to up. Next is the triangle type of charts we see. So triangles are well-known charts pattern used in technical analysis. So the three types of triangle which vary in construct and implication. So are the symmetrical triangle, ascending and descending triangle we have. These the chart pattern are considered to last anywhere from a couple of weeks to even several months also. So if we see in the chart, we can easily see that the market moment is going to be the precise. So this is breakout. Okay. So first one is a symmetrical triangle. The symmetrical triangle is a pattern in which two trend line converge toward each other. Okay, different trends patterns, and this pattern is neutral in that a breakout to the upside or downside. So we can see the one breakout over here. Okay, so that is all about the breakout. So it's a confirmation of a trend in that particular direction. Now ascending and descending triangle we can see. So this is ascending triangle going up, and this is the descending triangle. So in an ascending triangle, the upper trend line is a flat. Okay, you can see in the graph, this will be the what you call flat shape, while the bottom trend line is upward sloping. So this is generally thought of a bullish pattern in which chartics looks for an upside breakout. So we can easily say that this is in bullish trend. So in descending, if you see, the lower trend line remains the flat. Okay, and this line remains flats, and this is generally seen as the bearish trend that we can see that the market is going down and down. So next are flags. So flags are a pause in the trend where the price becomes confined in a small price range between parallel lines. This pause in the middle of trend gives a pattern, a flag-like appearance. Okay, so we can see in the chart that this is in bearish flag. Okay, in a downward. So this is sell. This we have to sell, or again market will start go on following, and this we can see as in flag. Next coming to the bullish flag. So an uptrend. So from here market start moving. So this shows the buy signal, and this point shows the sell signals, and the pattern will become like a flag. So they are the pause in the trend, okay, where the price becomes confined in a small price range between parallel lines. So this pause in the middle of a trend gives the pattern flag-like appearance. Okay. Now comes the pennants. So pennants are similar to the triangle we have already seen. Yet smaller pennants are generally created by only several parts. That is the difference between the triangle and pennants. So the pattern is created as prices coverage. So covering a relatively small price range, mid-trend, this gives the pattern pennant appearance. Okay, so we can see in the geographical representation. So these are the movement of the sticks. So here, from here to here, these are called pennants. Next is the candle stick charts. So you can see in the graph here chart. So bullish and bearish. Bullish will be represented with green and bearish will be represented with red. So both shows upper where is high, and this upper one says the close price and below says the open price. And here is reversal. Closer will be shown in the below and upper will be shown, open will be shown upper side. And this is the body, and this is the low bullish, and this is low bearish. So we can easily say contain of open, high, low, and close values each time period you want to display. So you can use the candlestick basics. Next comes the Elliott wave theory. So we have seen the Dow Jones theory, and this is Elliott wave theory. So Ralph Nelson Elliott developed the Elliott wave. It's like a wave moment of shift. So we can see this waves. Okay. theory in the late 1920s by discovering that the stock markets thought to behave in a somewhat chaotic manner, in fact, traded in repetitive cycles. Okay, so he discovered this the theory of wave. So it all about the reaction of the investors to the outside influences or even predominant psychology of the investors or any message which came out at that particular time. So he found that upward and downward swings of the mass psychology always showed up in the same repetitive pattern, which were then divided further into patterns he termed different waves. So he termed that 1, 2, 3, 4, 5, and then A, B, C. So here if you see, so he prediction on a unique characteristic he discovered in a wave pattern, an impulsive wave. So which goes with the main trend, always show 5 waves in its pattern. So this is called impulsive. 1, 2, 3, 4, and 5. So these are impulsive waves in the pattern. On a smaller scale, within each of the impulsive waves, the 5 waves can again be found in the smaller pattern. The same pattern repeats itself infinitely. So these ever smaller pattern are labeled as different wave degrees in the Elliott wave principle. Okay. In the financial market, we know that every action creates an equal and opposite reaction. We all know this. We have studied this and we have seen the reactions also. As a price movement up or down must be followed by a contrary movement. So price action is divided into trend and corrections or sideways movements. So trends show the main direction of prices while correction move against the trend. So that is the two things, trend and correction. So Elliott labeled these impulsive and corrective waves. So in theory interpretation, if you see, we have seen 1, 2, 3, 4, 5, then A, B, C. So he interpreted in this way. So 5 waves move in the direction of the main trend followed by 3 corrective waves. That is a 5-3 moment. Okay. And 5-3 move complete a cycle. So here, if you see, it's a cycle completion. So this 5-3 move then becomes two subdivision of a next higher 5-3 wave. So the underlying 5-3 pattern remain constant to the time span of each may vary, depend on the time. So if you look at the following chart made up of 8 waves, that is 1, 2, 3, 4, 5, A, B, and C. So we can see in the chart that 3 waves in the direction of the trend are impulses. So 1, 2, 3 are comes under the impulses. So these waves also have 5 waves within them. So 1, 2, 3, 4, and 5. So 1, 3, 5 are the top, and 2, 4 are below 1. So the wave against the trend are corrections and are composed of 3 waves. So we can see in the diagram and we can predict it. Now, indicators. So market indicators. So one is the volume of trade and then breadth of the market. So what is volume of trade? Volume expands along with the bull market and narrows down the bearish market. So if there is a bullish market, so volume traded will be high. In the bearish market, it narrows down. So in technical analysts use volume as an excellent method of confirming the trend. So in a bullish market, the volume of trade is large with rise in the price. But in the bearish market, the volume of trade is large with fall in the price. So volume confirm the chart patterns. So we use these volume in the charts and put it in the graph. When it comes to breadth of the market, so it is the net difference between the number of stock advanced and decline during the same period is the breadth of the market. So we take the difference, the number of stock have advanced and the number of stock have declined, and the period should be the same. So a cumulative index of net difference measure the market breadth. In a bullish market, a bearish signals given with the A bar D line slopes are down and the market is rising and vice versa. So these are the two things, volume traded in the particular market. So obviously in bullish market, the volume traded will be high, and bearish it will be less with the less price. And breadth shows the difference of the stock advance and the decline in the during the same period. Now we know the short sales. We heard about short sales and this let's study about it. The second technical indicator, also known as a short interest. So it refers to the selling of shares that are not owned. Okay. So what here does is, and one of the trader will take some shares and he will confirm that he will return the same number of shares, not the price. So at a particular timing, within that time, he will return it. Okay. And he will come to know that the market is going to fall further. So he will purchase it, and he will not purchase it, he will take it. He is not owning and he sells it. So from whoever he has taken the shares, and he had to return back the shares. So he utilized the market trend. For example, if it is a bearish trend, he will take and he will sell. For example, 100 rupees, he will take 10 shares. Okay, then he will sell it for again 90 rupees. So market goes down, the same shares he will purchase for 30, and the difference amount he will earn. So that is called short sales. So the bears are the short sellers who sell now in hope of buying later at a lower price. Next comes the moving average. So moving average are the indicators used to calculate the lines. Okay. So market do not rise in the straight line. We all know. So there isn't trend happens in the market line. So we use a moving average method of the calculation. So there are 9 days moving average, 5 days moving, 3-day moving average, 30 days, 12 days, 15 days. So it depends on the how much moving average we are going to calculate. So let's see the simple moving average method. Simple moving average is formed by computing the average price of a security for a specific number of period. So most moving average are based on closing prices, and 5-day simple moving average is the 5-day sum of closing prices divided by 5. So let's see an example. So these are the trading days we can see in the chart. So this is first day, second day, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th. Now we are going to calculate the moving average line. So the closing price we know. Okay. So now it is 5 days moving average. So what we do, we add this all 5 days price. Okay. After adding, so we divided it with the 5 and we get the 25.4. Now next, we will leave the first one. Then we take next 5. Then again we divide it with the 5. So again we leave this. Again we calculate with the help of 5 days. Again we take, and again the average will be calculated. Again we leave this, and again 5 days. Again we will take the 5 days. So again the average will be calculated. So how many days we are taking? So we have to take that many days data, and that has to be divided with the number of. And next, leaving the first one, next 12 or 5 or 8 we have to take, and then we have to calculate the moving average. So we calculate 5 days, 9 days, 12 days, depends on that. That can be calculated on Excel sheet also. Okay, so this is how it is calculated, and these data will be put in the chart. So this chart represent the closing prices, and this chart, this line represent the moving average line. And method to know in this is, if the moving average line is cutting from the bottom to the stock market price, it says that the stock price is going to fall. Okay, and if the moving average line is cutting from the above side, so this happened here, okay, then the stock price is going to become upper. So we have to identify two things here. If the moving average line is cutting from the below, stock prices are going down. If it is cutting from the upper side, then the stock price are going to up. So this is why we use the moving average analysis. Now coming to the next is the relative strength index, that is called RSI, which was developed by a Wells builder. Okay, so here we calculate again for 5 days, 7 days, 9 days, and 14 days. So here we will come to know how actually done, and the formula used for RSI is 100 minus 100 divided by 1 plus RS. So to calculate RS, we use the formula average gain per day and average loss per day. Okay, so if RSI crosses 70, there may be downturn. If RSI falls below, there will be upward trend. So that has to be identified. So you can access this in money control. You can find any company's RSI chart or moving average chart, you can go to the moneycontrol.com, BSC website or NSE website. You can see this also. So if you see the problem, so these are the dates we have, February 4 to 19, and these are the prices. And if we see the first two one, so price was 300 and second date was 304. So there is a gain of 4 rupees. Then for 7 to 6, so price even goes up, then the gain was 15 rupees. Then from 7 to 8, it has gone down. So the loss is 2. So again to 17, 19, again the gain, so there is 2. And 319, 333, again gain 14. 333 and 331. So there is a loss of 2. So again, comparing 13 and 14 data, we is a gain, and 14 and 18, so 32 and 48. So if you take the gain of average, so total gain is 52, and days are 6, 1, 2, 3, 4, 5, 6. So total are 6 here. So we divided with the, and we get 8.67. Now if you look average losses of days, we have 3 losses. So total is 6 and divided by 3. So we get 2. Now calculating the RSI. So here the formula is used that 100 minus 100 divided by 1 plus 4.335. So 4.335 is calculated with the help of the formula, so that we know that the RS calculation formula. So that is all about average gain per day. Okay, average gain per day and divided by average loss per day. So that was 8.67 divided by 2. So we got 4.335. So we put it in the formula, and 100 minus, so here we get 18.74, that 100, so 81.26. So this is how it is calculated. If you put this calculation continuously on the table, so we get this type of data. And this is 70 line and this is 30 line. So going down, so here we can see this is upper limit reach. So then it starts falling. So again upper limit reach, okay, then again start falling and falling. So again here sell signal, and goes on when it's reached to the bottom line, and again it start moving up. So this shows the buy signal. So this is how the relative strength index is used. Now coming to the next is the rate of change calculation. So ROC, we call it, measure the rate of change between the current price and the price and numbers of days in the past. It can say 12 weeks or 12 months, it can be calculated. So he can here we can easily identify whether it is overbought or oversold with the comparing with the prices. If you see the calculation, so today's price, price end days back, today's price end days back into 100, and into 100 minus 100. So Drew formula is used. One is the percentage method, okay, ROC1 and ROC2 method, okay. So they will be added together. So if you see the problem, okay, so this is 7 days ROC. So these are the dates where they traded, okay, and these are the stock prices. So now we are calculating for 7 days. So obviously, so 7 days when it is calculated, so 1, 2, 3, 4, 5, 6, 7. So this added, and here we take 108.38. So this price is compared with the n number of days. So this, if you see here, so 254.90, that is divided with 235.20. Okay, so we get 1.0837, and that will be multiplied with the 100. So we get 108.38. Now if you put it in the second ROC2 method, so if you minus 100 from the available value, so minus 100, so we get 8.38. So again we go on calculating for next, then here, then here, then here, then here, and then here. So this again is the calculation of ROC. So coming to the technical analysis and fundamental analysis. So fundamental analysis analyze the financial strength of corporate, growth of sales, earnings, and profitability. But when you come to the technical analyst, it's all about the attention on the past history of prices. And in fundamental analysis, estimate the intrinsic value of the shares. So, but in a technical analysis, it's all about the prediction of the short-term price movement. And in fundamental analysis are of the opinion that supply and demand for a stock depend on the underlying factor, that is EIC framework. But in technical opinion, so that they can forecast supply and demand by studying the price and volume of trading using the charts and patterns. So I hope you have understood the